Corporate finance practice problem using one note. Warrant versus stock price percent increase. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side, Practice Problems tab, down in the 1926 Warrant versus Stock Price Percent Increase tab. Also note, when using OneNote, look at the Immersive Reader tool. Our presentations will also be in the text area with the same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top. We're going to be calculating in the blue area by the side and on down below. We're looking at our warrants, considering what would happen if there was an increase in the stock price to the value of the warrants as well as to the value of the stocks if we were to invest in the stocks. And so what we would expect to see when we have a percentage increase, when we look at the percentage increase, the percent increase for the warrant possibly being greater than for the stock, even though the dollar increase for the stock may be greater than that for the warrant, given the fact that the warrant kind of acts as a leveraging kind of component. So let's see how this plays out. We have a warrant to buy one share of common stock. The cost of the warrant then is $7. If we exercise the warrant, we can purchase a common stock with it, one share of common stock, at $18. The stock market price, meaning if we simply purchase the stock outright, would be $22. So if we had the warrant, then we could purchase the stock for $18 as opposed to $22, but to buy the warrant, it costs $7. So then we're going to assume changes that take place in the future, including the stock price then goes up to $31, and the warrant sells at its theoretical value with no premium at that time. So no premium at that point in time later at the sale point. So calculate the percent increase in the stock price and warrant price. So let's first take a look at the intrinsic value here. So we're going to say that we have the stock market price of the 22 and the exercise price is 18. So if we had the warrant, then we can basically exercise it and buy the stock for $18 as opposed to $22. 18 minus 22 means we'd have an intrinsic value of $4. Then there's a speculation premium because we're got to buy the stock, the warrant. If we were to buy the warrant, it costs $7, and if we were to exercise it immediately, then we'd only get a $4 benefit. So that means that we'd have a speculative premium in the price, $3. It's $3 over the intrinsic value of the warrant if we were just to buy it and then exercise it. Let's think about the percent increase in the stock price then. If we were to say, okay, if I had bought the stock at the market price of the 22 and then it went up to 23, we'd see an increase. What would that increase look like if we just bought the stock? The new stock price is 31. The starting stock price is 22. So that would be a $9 increase in the value of the stock. If I compare that $9 to the beginning price of 22, we get the percent increase, which is the 40.91. So in other words, I could take the 9 divided by the 22. We get move the decimal 2 places over the 40.91% increase about. Let's think about the warrants then. What would happen to the warrants if we saw this increase in the stock price? Well, we can calculate the new warrant price. We're going to say the new stock price is 31. The exercise price is 18. So that's going to give us our intrinsic value of the 13 in this case, because now if we had the warrant, we could still buy the new stock at the exercise price of 18. The market price is now 31. The difference is 13. Now, we're also assuming that there is no, as there was up top, speculative premium here, meaning we're going to assume here that the cost is equal to the intrinsic value. So, and notice if there was a premium, then it would be even higher, right? That would mean that the warrant price would be higher than the $13, but we're going to assume that the speculation premium has gone down as time has passed. So the percent increase in the warrant then would be, we have the new warrant price of the 13. The starting warrant price was 7. So meaning the new warrant price is 13. If we were to have the value of simply the warrant at this point in time, we bought it for $7. The difference then is $6. So the difference then, of course, is less in a dollar amount because it's $6 versus the $9 change that we had on the stock. But of course, to invest in the stock, we invested $22 versus investing only $7 when we invested in the warrant. So that means we have a $6, but if we were to compare that to the starting price, which again is much less than the 22 we invest in the warrant, if we only bought one warrant, we would have invested only $7 as opposed to if we invested in the stock $22. And if we get the percentage change, then we're taking the 6 divided by the 7. 6 over 7 is the 0.85%. So notice that the percentage increase here for the warrant is much higher than it is for the stock, even though the dollar gain is higher from the stock than it is to the warrant. And that's because, of course, we purchased only one warrant. We could have, and we'll take a look at and explore this more in future problems, purchased more warrants to equal the stock price. I mean, we could have bought, for that $22 stock price, 22 divided by 7, we could have bought around 3 warrants for the same price as the stock price and whatnot. And we'll take a look at more of that in the future. But just note, if we bought one warrant, we only invested 7 versus the stock, which we would have invested the 22. Then, of course, the stock price would have a bigger dollar gain here. But as the stock price in this case went up, but the warrant has the bigger percentage gain, given the fact that, once again, you're kind of comparing to a smaller investment price. And that's due to kind of a leveraging type of factor that takes place with regards to the warrant. So the movement in the stock price causes the warrant to rise on a smaller initial investment. So the initial investment was smaller due to it being leveraged. The percent gain is larger for the warrant than the stock.